Hello and welcome to today's podcast and live chat webinar. We're waiting for the viewers to join and we'll be getting started shortly. So great. So I see the viewers have joined. So we'll be getting started now. Today's session is going over a very popular topic, which is how to make mega backdoor Roth contributions to a solo 401k and then convert those over to a Roth IRA at Fidelity. So hopefully you find this presentation helpful, and we'll be looking to get started here. Shortly. So let's get started. So this page right here gives a quick overview of what we're going to be discussing, which is the benefits really of a mega backdoor Roth solo 401k and the details of how to transfer it to a Roth IRA at Fidelity. So the focus is going to be transferring after-tax solo 401k contributions to a Roth IRA. And once it's in that Roth IRA, you have the potential for tax-free growth. With a solo 401k through our company, you can contribute as much as $57,000 for 2020, or $63,500 if you're 50 or older, or for 2021 it goes up to $58,000 or even $64,500 if you're 50 or older. So the potential for saving significant funds is high. So let's first start out by setting a baseline in terms of just how to set up a mega backdoor Roth solo 401k and then transfer the funds over to a Roth IRA. So first off, you need to work with a provider that offers a mega backdoor Roth solo 401k like us. So that's going to be a provider that allows for the voluntary after-tax contributions and then the in-plan rollover, the in-service rollover to a Roth IRA. You would then adopt the solo 401k. So for example, for our clients, we draft the solo 401k documents that are specifically for your business, that are going to come with all those features already drafted appropriately into the document. The ability to make voluntary after-tax contributions and the in-service rollovers. You need to have an EIN specifically for the solo 401k. So this is an EIN that's different than the EIN that you might have for your business. Like let's say you have an EIN for your S corporation, or even an EIN for a sole proprietorship. So then we'll draft the Fidelity brokerage forms. We'll pre-fill those forms that are specifically for your plan. It'll have the name of the plan. It'll have the EIN number for the plan. There'll be separate sub-accounts. So you've got, pre-tax, you may have pre-tax funds. You may have Roth solo 401k funds. And then of course the voluntary after-tax sub-account. And then if there's more than one person, let's say it's a husband and wife, then there could be a set of 6 accounts. Those forms get submitted to Fidelity. Fidelity generally takes 5 to 7 business days to open the account. And just keep in mind that Fidelity is not the solo 401k provider. They're simply the custodian of the funds. You are the trustee. You're the one with the checkbook control. We, as the 401k plan provider, provide the ongoing compliance support, like the 1099-R that would need to be issued when you transfer the funds from the after-tax account over to the Roth IRA account. And we'll get into more details on that here as we go through these slides. So once the funds are in the after-tax sub-account at Fidelity, it's time to process the conversion. So that would be specifically moving the funds from that voluntary after-tax account for your solo 401k over to the Roth IRA at Fidelity. And I see that we got questions, so please don't hesitate to ask questions, and I'll answer those questions as we go through the slides. If you're watching on a recording, you can ask the questions in the comments and we get back to you within 24 business hours. And while we're talking about some of the housekeeping items, please like this video. Please subscribe for more videos like this. We will post chapter links when the video gets posted to YouTube. So if you're watching on a recording, you can jump ahead to certain spots. So again, back to the steps, the funds get converted over to the Roth IRA, and you're going to use the Fidelity's form. We will help you pre-fill it. We've got slides on this presentation that will give the details as well in terms of how that form gets filled. The form then gets submitted over to Fidelity. It can be submitted by fax. It can be submitted by upload. And then you have to let us know about the transfer, because we don't have access to your account, of course. But in order for us to prepare that 1099-R, we need certain information. So we have an online form where you'll submit that information. It's a quick 2-minute form. That'll put it in the queue for us to be able to issue the 1099-R by the beginning of the following year. And again, thank you for the questions. We'll get through a section of these slides and then we'll knock out these questions. So let's go with some images, an infograph of the process. So again, you first start out with a 1-participant solo 401k plan. That's what a solo 401k plan is. It's a 1-participant plan. Even if you got multiple participants, it's still considered a 1-participant plan. Like you could have husband and wife, etc. In this situation, we've just got one person. So they've got the 3 different accounts, the 3 different brokerage accounts. Each is set up in the name of the plan, XYZ Trust. There's 1 sub-account for pre-tax funds, a 2nd for Roth, and then a 3rd for the voluntary after-tax funds. So the contributions are made into the voluntary after-tax sub-account, and then they're moved into the Roth IRA. That's the conversion part. So that's the part where we're going to go through the form. You got to let us know about the money that gets converted so we can issue the 1099-R. Here's another example with 2 participants. Again, a 1-participant plan can actually have multiple participants. Like if you have 2 business partners or a husband and wife that are both working in the business, spouses, whatever the case may be, and it's still considered to be a 1-participant solo 401k plan. So again, you would have separate accounts, except there's going to be 3 accounts for each person. Each person makes their voluntary after-tax contributions based off of their self-employment income into their solo 401k account, and then moves it over to their own Roth IRA. So their participant 1 did it, then participant 2 did it. So let's pause and knock out some of these good questions. So the first one, I have a 401k pre-tax from a previous company. Can I move this to the solo 401k? Yes, you can. You can always move money from a former employer plan over to the solo 401k, and we handle the transfer forms or help guide you through the process if it's an online or telephone process. Next question, since we get new EIN, anything to do with tax filing with this new EIN? Only to the extent that you are, say, doing an in-plan conversion. The 1099-R would be issued under the EIN for the plan, or if you're taking a distribution, again, a 1099-R issued under the EIN for the plan. So that's when the EIN is generally used in the context of tax filings. Even if you're doing a 5500 EZ, because the value of the plan is over $250,000, that's filed by the plan sponsor, meaning your self-employed business. So that's filed under the EIN for the business. Next question, and we're actually going to answer this in one of the slides. What is the deadline for conversion from voluntary to Roth for 2020? There's no deadline to convert the funds. There's a deadline to contribute, and we'll talk about that as we get to those slides. Next question, can the after-tax contributions be transferred into an existing Fidelity Roth IRA? Yes, they can. You don't have to set up a new Roth IRA. It could be an existing Roth IRA. Next question, is this something that should be done yearly? I thought the rollover could only be done at retirement. Good question. You can transfer generally when you're moving money out of a solo 401k, you've got to meet a triggering event. However, there are exceptions. So voluntary after-tax contributions can be rolled out at any time. So that's one of the great things about this strategy. Of course, if you're trying to transfer money out of the Roth sub-account or your pre-tax sub-account, you're going to have to meet one of the triggering events. Generally, you got to be at least 59.5 to do so. But with the voluntary after-tax contributions, you can roll them out at any time. No triggering event required. Next question, if I have a solo 401k pre-tax and I move this to the after-tax, then to the Roth IRA, will I have to pay tax if I have traditional IRA? So first of all, you cannot move money from your pre-tax account to the after-tax account. You're making after-tax contributions. So just send us an email if you're an existing customer to business@mysolo401k.net. Please put your plan name in the subject line and put a brief description in the subject line so we can help you out. Next question, importance of conversion to 401k Roth versus Roth IRA. So we'll talk about that in one of the slides. So thank you so much for those great questions. We'll get back to the slides here and keep moving forward. So again, just to recap, you need to find a mega backdoor Roth provider. You've got to qualify, of course, to be able to set up a solo 401k, which means that you are self-employed with no full-time W-2 employees working for any business owned by you or owned by a spouse. And again, find a provider that allows for the after-tax contributions and in-service distributions. Of course, you want to find one that has experience and have done this before, that can assist with establishing the sub-accounts and assist with the ongoing compliance support, like the 1099-R reporting. Again, moving forward and laying the foundation, just in terms of how much I can contribute and getting money into the plan, your ability to contribute is going to be based off of your self-employment income, your age, whether you could participate in another retirement plan, the type of contribution that you want to make. So in terms of the different types of self-employed businesses, you could be taxed as an S corporation, in which case your ability to contribute is going to be based off of the W-2 wages that you receive from your self-employed business, taxed as an S corporation. You could be taxed as a sole proprietor, like a single member LLC, a disregarded entity, or just an unorganized business, a sole proprietor, in which case your ability to contribute to the plan is going to be based off of the self-employment income that you report in your 1040, specifically line 31 of Schedule C, less 1/2 of the self-employment tax. That's how you have to do that pre-calculation to figure out your self-employment compensation before you figure out how much you can contribute to the plan. You could be self-employed as a partnership, in which case your ability to contribute is going to be based on what's listed on line 14 of the K1. Again, you got to do a pre-calculation if your self-employed business is taxed as a partnership, where you have to reduce that number by 1/2 of the self-employment tax. And with all of these types of self-employment compensation, you're not going to consider investment income. You're not going to consider wages from your W-2 day job. Now, we'll again set the baseline with some of the basics. I mean, you could be making other types of contributions. With this presentation, we're really focused more on folks that are making after-tax contributions and then want to roll it over to a Roth IRA. But you may have other objectives, like making pre-tax employee contributions. So here, your ability to contribute is going to be 100% of your self-employment compensation, however that's defined. W-2 wages, line 31 of Schedule C, less 1/2 of the self-employment tax. And you can contribute 100% of that amount up to $19,500, or an additional $6,500 if you're 50 or older. But you do have to reduce it by any contributions that you make to another plan, like if you contribute to a 401k through a day job. Alternatively, as opposed to making a pre-tax employee contribution, you can make a Roth contribution, in which case that would be part of that $19,500 limit, or an additional $6,500 if you're 50 or older. That would go into a Roth sub-account. Keep in mind, like we mentioned before, you can't transfer money out of the Roth sub-account typically until you're at least 59 and a half. You have to beat that triggering event. So if your goal is really to get it into the Roth IRA, as you'll see with some of these scenarios, you may want to pass on making an employee contribution. As far as employer contributions, those are always pre-tax contributions. Here, the ability to contribute is going to be a function of how your business is taxed. If your business is taxed as a corporation, like an S corporation, it's going to be 25% of the W-2 wages. If it's taxed as an independent contractor, like a single member LLC, where it's on line 31 of Schedule C, it's going to be 20% of your self-employment compensation. Again, self-employment compensation is line 31 of Schedule C, less 1/2 of the self-employment tax. If your business is taxed as a partnership, it's the same percentage, except it's line 14 of the K1, less 1/2 of the self-employment tax. So it's 20% of that number. But again, as far as employer contributions, those are always pre-tax contributions. So if your goal is to get the money into a Roth IRA, that's not going to help you. because you generally have to be at least 59 and a half to be able to roll those types of contributions out. So now we turn to the voluntary after-tax contribution limit. Here, you can contribute 100% of your self-employment compensation up to the overall limit, which is $57,000 for 2020 or $58,000 for 2021. Of course, you have to reduce that by any other types of contributions that you make to the plan. Like if you do decide you want to make some employee or employer contributions, you'd have to reduce that amount by those contributions that you make. You would also have to reduce it by any contributions made to a 403B. Generally, you ignore contributions made to another retirement plan for purposes of figuring out how much you can contribute as a voluntary after-tax contribution. The one exception is the 403B exception, where you have to consider those contributions and reduce how much you can contribute to the solo 401k. So that kind of sets the scenario, that sets the baseline in terms of the rules. We'll talk about some scenarios now in a second, but let's first knock out some more of these good questions. Thanks so much for asking. So let's see, and thank you for the positive feedback. So next question here, 3 sub-accounts. Can we have 6 sub-accounts with 2 different providers, such as Fidelity and Vanguard? You certainly can. One exception is that Vanguard doesn't support third-party plans like our plan. So Vanguard's not going to be an option, but you could have, say, Fidelity and Schwab if you wanted to. Next question, is there a reason why not to convert from after-tax to Roth 401k instead of Roth IRA? I'm thinking in context of accessing at age both 55, etc. So we'll talk about the Roth 401k versus Roth IRA. We've got a couple questions on that. And let's go through that slide. And then if that doesn't answer it, we could certainly answer more questions. Next question, I have a Roth IRA at Schwab open for a while. If I open a new one at Fidelity, does that restart the 5-year requirement? Great question. So, but really the issue here is that you are going to have to look at the ordering rules for purposes of taking a distribution from a Roth IRA. And so that's a bit out of scope of this presentation. I want to make sure we get through all the slides, but hopefully that gives you something to start with. And then if that doesn't, you can always send us an email at business@mysolo401k. We can answer more questions. Can I fully contribute to after-tax account and also contribute $6,000 to a non-deductible IRA account, assuming I take $100,000 of W-2 wages from the S-Corp? So certainly the fact that you're making contributions to a solo 401k is not going to preclude you from also making backdoor Roth IRA contributions. Of course, you have to consider the rules around that. For example, the pro rata rules and whether you have the income to support it. But again, the fact that you're making these mega backdoor Roth solo 401k to Roth IRA contributions is not going to stop you from doing that. Next question. So I think the question about the LLC-A and LLC-B, I'm not quite following that, but I think you might be trying to justify setting up a solo 401k. Ultimately, it comes down to you need to have the self-employment income that you report in your taxes to be able to justify having a solo 401k, and then your ability to contribute is going to be based on that self-employment income. Like if you have income that you're reporting on Schedule C on your taxes. Ultimately, if you don't have positive income, though, you're not going to be able to make any contributions because you have to have, you have to earn income before you can save it. Next question. Can the source of the voluntary after-tax contributions be from other income sources? It must be from self-employment income. Well, you definitely have to have the self-employment income to justify the contribution. As far as actually transferring the funds, it can come from a personal account or a business account, etc. So hopefully that answers your question. So let's go through some scenarios here. So first scenario is that we have a one participant, one person, they're under 50. Their goal is to maximize the after-tax in order to convert to the Roth, and they got $100,000 of self-employment compensation. So here they're going to skip the employee, skip the employer. They can do 100% up to the overall limit, which is $57,000 or $58,000 for 2021. Now let's flip one of the factors. Let's make this person 50 years or older. What changes? Nothing. So here the takeaway is that the fact that you're 50 or older doesn't increase your overall limit. So you're still only going to be able to contribute 57,000 for 2020 or 58,000 for 2021. Next question. Now let's go back to the base, but instead of one person, it's two persons, and they each have $100,000 of self-employment compensation. So the takeaway here is that each person can do up to 57,000 for 2020 or 58,000 for 2021. Next question. Now let's assume that the person contributes $19,500 to a day job. So they're again under 50. They got $100,000 of self-employment compensation. So the takeaway here, they're not going to be able to contribute any employee contributions to the plan because they already maximized to their day job. They want to skip the employer contributions because their goal is really to get the money into a Roth IRA. So the takeaway here is they can still maximize and put $57,000 or $58,000 for 2021 as an after-tax contribution to the solo 401k because the limit is not impacted by contributions made to a different plan. If they had put in $19,500 to the solo 401k, per the rule that we talked about before, they would have to reduce how much they can contribute to as an after-tax contribution to the solo. So the mechanics now of how do I make contributions? So of course you can make the contributions by writing a check. You can write annual contribution in the memo line. You could do an electronic transfer if that's acceptable. Typically the brokerage firms where folks have their solo 401k accounts at don't allow for electronic transfers from an external account. Fidelity, though, is one of the exceptions where they do. And we can send you information from their website about how to do that, how to execute that. So each person deposits their own contributions into their own account. If it's different types of contributions, it's got to be into different sub-accounts like we saw with some of the infographs. The deadline to make the contributions is assuming you set up the plan, for example, and you want to make these contributions for 2020, assuming you set up the plan before December 31st, 2020, you'll have all the way up until your business tax return deadline. So if your business is taxed as a partnership or an S corporation, it's going to be March 15th or September 15th if you file the timely extension. Obviously, we're after March 15th, but if you file the timely extension, you have up until September 15th. If your business is taxed as a sole proprietorship, then now you actually have up until May 17th because the IRS automatically extended the deadline. Or if you file in timely extension, you have up until October 15th to make the contribution. And all that's clear based on IRS publication 560. So let's see here. Let's go back to some of these questions. Thank you so much for all the good questions. And then we'll get back to the slides. So yes, we do reporting, and we'll talk about that as we get to some of the future slides here, or the subsequent slides. Yes, so we already answered the question about how you can do but no problem, but good question. Just to be crystal clear, participating in a solo 401k, making the mega backdoor Roth contributions, even converting over to a Roth IRA is not going to stop you or preclude you from being able to do a backdoor Roth IRA. Next question, solo 401k funds grow tax-free, correct? Yes, they do. They grow tax-deferred, to be more specific, but you're not taxed during the time that the funds are in the plan and can be rolled over to a Roth IRA later on. Yes, they can, subject to the distribution rules. Generally, you can't transfer the funds out till you're 59 and a half. One exception is voluntary after-tax contributions, where they can be transferred out at any time, no triggering event. So a question about being able to set up a plan. So that's a little bit outside the scope of this presentation, but just the takeaway here is that, I mean, ultimately you got to have that positive self-employment income to justify setting up a plan. And then your ability to contribute is going to be based on that income. Here, if you're talking about income from last year and you haven't already set up a plan, then it's going to be too late to do the employee and after-tax contributions for 2020. Is there anything else that we need to do besides the 1099 filing? Well, so yeah, that's great timing because we're going to go through reporting the contributions in these next set of slides, as well as the next question about the 1099-R. So let's turn to these slides then, because I think it's going to be helpful to the last set of comments there. Thank you so much for those good comments. Please don't hesitate to ask more. So in terms of how do I report the contributions? For an S corporation, it depends on the type. So with the pre-tax contributions, those are taken out of box 1, they're put in box 12 because that's reducing your income. Roth contributions, of course, don't reduce box 1, but they still go in box 12. Voluntary after-tax contributions, you can but don't have to report those in box 14 of the W-2. Employer contributions get reported on line 17 of your 1120S. If your business is taxed as a sole prop or a single member LLC, then really the only thing that's going to be reported are pre-tax contributions. So if, again, with the focus of this presentation being the voluntary after-tax contributions, if that's the only type of contribution that you make, then it's not reported. Employer contributions are reported because they're always pre-tax. They go on line 15 of Schedule 1 of the 1040, just like the pre-tax employee contributions. Likewise, if your business is taxed as a partnership, from a 1040 perspective, it's the same. You would just have the additional issue of reporting pre-tax contributions on line 13 of the K1. So, and I know we had more questions about the 1099-R. We're going to be addressing that here in a few slides. So now we're going to turn to the mechanics of someone that has an account of Fidelity and moving it over to a Roth IRA. So just to kind of set the stage here, we definitely have a large number of clients that have accounts of Fidelity. We prepare all the paperwork. Keep in mind, again, Fidelity is not the plan provider. They're simply the custodian of the funds. So we are the ones that would assist with the 1099-R reporting, not Fidelity. If you have questions on how much you can contribute, etc., we field those questions every day. So the form to move the money is called a investment, it's called a one-time withdrawal investment only retirement account form, which they have on their website. We have a link to it. If you go to our website and link to the page where we talk about this topic, we have a link to that form. We can quickly download it. So here we're going to go through the form in detail and talk about how to complete it. So section 1, you've got account number. So this would be if you're moving the money from your after-tax Fidelity account, you would enter your solo 401k brokerage account, the Fidelity brokerage account number for those after-tax funds. You're going to enter your name, enter the name of the solo 401k plan. You enter your name again as the plan participant. So you enter it above as the trustee, then again as the plan participant. Enter your phone number. Moving down the form to section 2. So here you're going to specify that you want to enter only the following amount of cash in your account and enter the dollar amount that you wish to convert. Moving down the form to section 3, you're going to select 3B, direct rollover, conversion, etc., that option. You're going to select the box titled Fidelity IRA, Roth IRA, etc. You're going to enter in the account number field, enter the IRA, Fidelity IRA account number, Roth IRA account number. You're going to enter your name since you're the owner of the Roth IRA. And then under section 4, you're going to sign and date the form. So here you're going to enter in that section 4, you're going to enter your name as the trustee. You're going to sign your name and enter the date that you sign. So very simple, straightforward. Submit the form to Fidelity. So if you are going to be converting less than $100,000, they don't require a medallion signature, or if you go and take it to a Fidelity branch, an investment center. So a lot of folks want to take it to the branch for that reason. Alternatively, you could mail the form to Fidelity, or you could upload it. Of course, if you're going to be uploading it or mailing it, and you're going to be converting more than $100,000, you're going to need to first get a medallion signature, which you would do at your bank is a good resource. You would want to call in advance and make sure that the person who is authorized to provide medallion signature is sort of like a notary in the sense that it identifies who you are. A good, just practical tip is to call the bank in advance, because a lot of times it's only 1 or 2 persons at the bank that are authorized to do that. On the form, they've got the address to mail if you're going to do it overnight or regular mail, and we've got to post it here too. Then we turn to letting us know about this conversion, because that's how we capture the information so we can do the 1099-R. So we have a form on our website to let us know about the conversion. We got the URL here on this page. You can go to our website, and in the upper right, there's a link to forms, and then you can find it on that page as well. So again, we, not Fidelity, issue that 1099-R, and we do it by February of the year following the conversion. So even if though the contribution might have been made for 2020, if the conversion's in 2021, the 1099-R is reportable for 2021. So we would prepare it and issue it by the following February. Like we talked about before, there's no deadline to convert those forms. There's really a deadline to make the contribution, like we talked about in the deadline page, but converting from the after tax to the Roth IRA, there's no deadline. So the amount that's converted is going to be reported again for the year of the conversion on the 1099-R. Then you would list it also on your Form 1040. If you follow the instructions for line 5A to list the amount converted in line 5A, and then any gains on line 5B. Again, we've got, you can let us know about the conversion by going to our website and clicking on forms. And there's a specific form that says after tax to Roth IRA, after tax solo 401k to Roth IRA. So that takes us to the end of the slide. So let's go back to more comments. So please, we have more time if you want to ask more comments. Thank you so much. So the next question here. So yes, you can convert the funds, the after tax contributions right away. I think that answers that first question. So as far as the triggering event, so there's no triggering event required for after-tax contributions, but other types of funds like the pre-tax and the Roth, generally it's going to be at least 59.5. We have a page on our website that gives more detail. I'll post the link in the comments after this post to YouTube. Next question. So yes, you can make contributions as a lump sum, or you can make it in multiple contributions, periodically, every pay period, every month, lump sum. You have up until your business tax return deadline, including any timely filed extension, to make those contributions. Now, keep in mind, if you're moving funds over multiple times from the after tax to the Roth IRA, you want to submit our online form for each move so that we have a nice paper trail to show and to document, and then it would all be aggregated on one 1099-R for the sum of all the funds converted. Yes, that's part of the service. We do the 1099-R. We prepare the 1099-R as part of our service. So our fees are just a totally flat fee. So we don't charge any type of percentage of the balance. We have an initial establishment fee of $425 and a flat annual fee of $125 a year. So the initial cost would be $550. That'd cover everything to set up the plan, plus the first 12 months of ongoing compliance support. On the anniversary date, we email you an invoice so you can pay the $125 annual fee. So yes, and I guess we didn't get to the slides about Roth versus Roth Solo 401k versus Roth IRA. We've got a lot of great material about that, and I'll include a link. But just to put it in simple terms, some of the key points are that with a Roth IRA, there is no required minimum distribution. That would certainly be one reason that folks want to put it over to the Roth IRA. Another practical reason is there might be a certain investment, like say a mutual fund at a Vanguard Roth IRA account, or it could be like here with a Fidelity IRA, Roth IRA account that they want to make. So they want to get their funds into that Roth IRA. So that would be some practical reasons. Reasons to keep it in the solo 401k would be that you can continue to invest more easily in alternative investments. Like if your goal is real estate or cryptocurrency, with our plan, that's one of the features. You can easily invest in alternative investments where it'd be more difficult. You certainly wouldn't be able to do that through a Fidelity Roth IRA, and more expensive to do it through your Fidelity Roth IRA. So if your goal is to be able to invest the money in alternative investments, a lot of people want to keep it in the Roth Solo 401k for that reason. Another reason is that you can take a loan. So you can borrow, you can take a 401k participant loan from a Roth Solo 401k. You cannot do that. You cannot take a loan from any IRA, including a Roth IRA. So next question. So just double checking. So even if I'm making a contribution now for 2020, I'll report the conversion on my 2021 personal return. Yes. Yes, the $125 fee covers all the ongoing compliance support for the plan. So that's, like we talked about in this presentation, of course, the 1099-R, support in terms of how much you contribute, taking it broader, support in terms of investing in alternative investments, mandatory plan updates and amendments, 401k loan document preparation. Those are some all very popular services that we're providing, and it's all for that flat fee. And then another question here, after restating with your plan, how does the stocks from the old accounts transfer to the new trust account without tagging them as a distribution? Can you explain? So if you are restating from, say, a account at Fidelity, your plan continues. So first of all, if you have a solo 401k at Fidelity, Fidelity's not doing any tax reporting for it. Your plan's going to continue. It's going to be restated under our plan document, which it does allow for the after-tax contributions and the in-service distribution. So you can do the mega backdoor Roth. It does allow for the alternative investments and loans, et cetera, et cetera. All the reasons that people want to switch over to our plan. And so it's not going to, that restatement is not it's not shutting down the plan. So no 5500 EZ, final 5500 EZ is going to be required. It's not being transferred over to another retirement account. So no 1099-R is required. You're really just replacing the documents and updating with our documents. And so for that reason, it's not a distribution event. It's not a rollover. It's not a reportable event, etc. Hopefully that helps. So thank you so much for all the great questions and everyone's time. Please like this video. Please subscribe. Again, if you're watching on the recording, you can ask questions in the comments, and we'll be sure to post the links to the Roth IRA versus Roth Solo 401k. We've got a ton of videos about how to make mega backdoor Roth contributions, much more in depth than we had time to talk about in today's presentation. And thank you again. I see we got one final question here, it looks like. So $19,500 is the employee limit for pre-tax or Roth. If you want to make after-tax contributions, like we talked about in the prior slide, then you can do 100% of your self-employment compensation up to the overall limit, which is $57,000 for 2020 or $58,000 for 2021. Now, you do have to reduce that by any contributions that you made to the plan, like employee or employer, but it's definitely higher than the $19,500. So again, back to the restatement question. Yes, you need to shut down the existing account. Like again, say you have a solo 401k at Fidelity. So that's got to come off of Fidelity's books, because on their books, that's their plan. And then the new account will be set up at Fidelity. You could do an in-kind transfer from the old account of those stocks to the new account. So if you have just pre-tax funds in your solo 401k at Fidelity, those stocks would go over to your new pre-tax account. Yes, the old accounts need to be closed, etc. But Fidelity is not going to do any tax reporting associated with that. Again, just to emphasize. Okay, great. Well, thank you again, everyone, and appreciate it. Take care.